My name is Sheree Scott. I am the Financial Education Manager here at Partner Colorado Credit Union. I handle all of our financial education, and I want to thank all the members that were able to attend this evening. I appreciate you giving up your time with your families and getting the information that we think is so necessary. And we want to thank Prudential this evening, who's going to actually be our presenters, and appreciate that they're also giving up time this evening to be here with us. I am going to list my information in the chat screen. Anyone, if you have any questions or concerns regarding the webinar afterwards, please feel free to give me a call or an email. Again, as you've seen, this is being recorded. We will send this out via email later on this week. And I'm going to hand it over to Larry Nazarenus so he can take up for the rest of the evening. Thank you all so much.
Thank you so much, Sharice. Appreciate your time. And just like Sharice said, we want to thank Prudential. We want to thank Steve and Joe for spending their time to help us out. Prudential is one of the companies that Partner Colorado partners with to really help basically us figure out what to do with our money and how scary it is in today's markets with not just COVID, but with everything going on with everything in the world. So one of the things I like to do is bring in folks that are experts at different things. And one of the folks that we really like working with, his name is Steve Sweeney. He's the gentleman that's gonna present tonight. He works for Prudential, and he has a nice little presentation about how to protect your investments, different strategies. One of the scariest things today is how the markets are so uncertain and so scary about what's going on. So Steve's going to give us a lot of great information. And, I think we want to leave it to where if you want to ask questions, don't hesitate to put your questions in the chat. Don't hesitate. You can always reach out and ask questions later on too. I know everybody doesn't want to always ask questions, on a webinar. So I'll also put my information on the chat screen, and you guys can always go from there. So what I'm going to do here is turn it over to Steve. And Steve, we really, again, appreciate your time, and I look forward to hearing what you say. So thanks a lot, and we'll go from here.
Thanks very much, Larry, and thank you, Sharice, for the opportunity to be here with you today. Greatly appreciate the chance to spend part of the day with everyone and really to share some of these ideas. And that's what this is all about, is sharing ideas. And again, it's a real privilege to do so, and really just greatly appreciate the opportunity and the time that everyone is spending with us. We know how valuable it is, and we'll do our best to make the most of it tonight as we address this topic of protective strategies for uncertain markets. And this really is a critical topic that draws from so many different aspects of financial planning in general. And as we go through this, I think it's important for us to really name, as we get started, especially sort of the firm center of this conversation. Now, I've had the opportunity to deliver this presentation numerous times, and there's a lot of really great material in here, a lot of great content that almost anybody can get something out of. However, I believe with this topic in particular, it's important for us to name this center to sort of give it a hub, so that all of the spokes of the discussion start to make more sense. Because if you consider this title, protective strategies for uncertain markets, sure, it sounds important, right? But for this 30 minutes or so of our day to actually mean something and to have meaningful takeaways, I think we have to speak to that center of the why it's so important. Otherwise, it can feel like a bicycle wheel with no hubs and just some spokes flying around. And so it's with that in mind that I really remind everybody that in today's environment, investors are facing more challenging conditions really than ever before, some would argue. Now, that's obviously more of a subjective statement, but when you look at all the different obstacles that we face, whether it's market volatility, historically low interest rate environment, inflation on an uptick here, the solvency of Medicare and Social Security, and on top of unprecedented headline risks, just to name a few, you can start to see why it's so essential to consider these protective strategies for our portfolios, especially when things are going well in the markets, right? Especially when we're on the upswing, if you will, or experiencing a secular bull run, as it's referred to for so long. Markets at all-time highs, and being able to protect in that environment is essential. And the good news here too is that it doesn't have to necessarily be at the expense of significant returns or opportunities for returns in the future. And I think you'll see what I mean as we go forward here. But while this can all probably seem intimidating, I would say that the good news with that, or the silver lining, is that you have a financial advisor in Larry who can help with some of these issues and help address some of the concerns if you have any. So it's with that as the backdrop that we'll start to unpack some of these issues and develop an understanding of ultimately how we can be in a better position to make informed decisions with the potential of uncertainty and how to protect in mind. Now, we also have to share these disclosures just to make it clear, who we are and who we are not, perhaps. Again, Larry is our host, the financial advisor there at the credit union. Myself, Steve Sweeney, as the presenter of this material. And again, I work for Prudential, one of the institutions that manufactures and distributes investment solutions, both on the life insurance side, the annuity side, the mutual fund side, and so forth. But bear in mind, and we're not going to talk about product tonight. This really isn't about a sales idea or selling or recommending any one particular product. We're not providing specific investment, tax, or legal advice. And this really is about value add above all else. But it is important for us to share these disclosures and remind everybody that even though we are potentially suggesting that positioning in portions of our portfolio in a protective manner, every investment, regardless of what type of investment is, comes with some form of risk. And we have to remind everybody of that. So to understand this scenario that we're in, let's start by taking a closer look at the current state of the markets. And I alluded to this earlier, but the chart on the left shows the value of equities, or in this case, the S&P 500 over the course of about the last 11 or 12 years or so. And what we're seeing is that US equity investors really have had the wind at their backs. The combination of a recovering economy, very accommodative monetary policy, really pushed financial asset prices higher for a number of years now. And even with the global pandemic, we obviously had a significant downturn, but experienced a very quick rebound in the right direction. And while most believe that this secular trend, this overall trend, is for rising prices in the somewhat near future, there's also a general consensus that volatility will remain as a part of the equation for a long time to come as well. And by volatility, of course, we mean that in the short term, there very well may be peaks and valleys that we have to deal with as an investor. Now, with respect to fixed income or bonds, the chart on the right shows the effects of what this 30-year bull market has had, and the fact that since 1980, the 10-year Treasury has declined, which means that the price of those bonds has gone up. All the while, investors have been rewarded with, sort of a healthy coupon payment or income stream. But today, interest rates continue to be low, and with the outlook for global growth somewhat unclear, many investors have begun to ask where they can find attractive returns going forward, particularly when we're thinking about positioning our portions of our portfolio in that sort of defensive manner, right? So, we want to be able to protect portions of our portfolio from this market volatility and the potential for a downturn. But if yields on fixed income are, essentially at all-time lows, is there risk embedded in that we would ultimately be losing money safely with nominal yields on fixed income? Particularly when you consider inflation starting to creep up in some cases, and in some environments, even maybe not creeping up, but really accelerating at a pretty significant clip. Now, while most of us here today already know this, perhaps let's just clarify for a moment what we mean by bear markets and what that term actually means. And so it's more of a technical definition to say that it's a 20% loss from a recent market peak. And interestingly, since World War II, the average bear market actually, has lost significantly more than that. So the average bear market has actually been closer to 30% and 31%. And this is all fine, well, and good to understand from sort of an academic perspective. But I think what really matters here is how bear markets might affect us as investors, or investors working to address these issues. And so we want to understand this on a much more practical level. And so therefore, it's valuable to understand that even with the normal frequency of these bear markets, of these normal market downturns, and the increasing length of retirement due to longevity, the average retiree will face a whopping 5 bear markets, upwards, on average, 5 bear markets during retirement that tend to last at least 14 months. Now, the most recent bear market didn't last that long. It was much shorter than that. Nevertheless, on average, over the course of history, they have proven to last much longer than that. And so it's important for us as retirees, near retirees, and people thinking about our financial future to consider how we might be prepared to address these issues. And depending on where we are in our financial time horizon, it very well may involve protection strategies. Now, the mathematics of loss are also an important part of this conversation. And what we mean by mathematics of loss is it really is basic arithmetic, but it's worth mentioning for nothing less than making sure that we're on the same page here. But it's also something that people don't always wrap their heads around entirely. And so what I'm referring to is a scenario where you experience a downturn in the value of your portfolio, and then what the required return would be to get back to even. So most people, or many people, assume that if you, for example, experience a 20% loss in your portfolio, that, well, you need 20% to get back to even, right? It seems on the surface logical, but in reality, the mathematics of loss tells us that to get back to even, you actually need 25% to get back. So if you think about this in terms of, dollars and cents, if you have $100 invested and you experience a 20% loss, of course, that means you have $80 in your portfolio then after that investment. Well, to get back to your $100 that you originally invested, if you experienced a 20% return, of course, 20% of 80 is only 16, which would get you to 96. So in reality, as we point out here on the slide, you actually need 25% to get back to even in that case of an $80 or $80 portfolio to get back to $100. Of course, 25% of 80 is 20, which would get you back to zero. And this is essential for us to understand as investors, particularly as we've seen this secular bull run for so long, because at some point it is possible that we experience these losses that could be significant. And if we want to then benefit from the return or back to the positive side of things, we want to be mindful of the fact that, it does take more of a return to get back to even. And the reality there too is that markets do tend to recover. So again, this is backward looking, which doesn't predict the future on any level, but it does give us some insight into tendencies, which certainly can be valuable to sort of understand the likelihood or sort of at least be a part of our decision-making process. And so that's what we're looking at here is in the past when we've experienced bear markets and where we've seen a 20% or greater loss from a recent market high, what the market tends to do in the subsequent 1, 3, and 5 year periods. And as you can see in the 80s, during, after Black Monday, the dot-com bubble, and even the Great Recession, we saw significant returns in the subsequent years after the bear market was realized, if you will. The only sort of downside to this, of course, or the potential trap in this scenario, is if an individual or an investor were to sell at any point during those market lows, right? So in this case, obviously, we're assuming somebody stays invested over that 1, 3, and 5 year period. And the reality is that's not always the case, right? And I think that to understand this, we have to first start with the fact that it is a natural tendency for investors, even the top, highest level Harvard grad, best credentialed investors have a natural human tendency to overreact to market conditions. And so when we start with that and we understand that, it helps us make our decisions perhaps a little bit more objectively, which can have a positive effect on our overall return, hopefully putting us in a position where we're not buying high and selling low, which of course is the cardinal rule of investing. And the problem is that often people don't stay invested in equities during those volatile times because we make rash decisions. And again, it's natural to do so. And we go through this cycle of optimism, euphoria, fear, surrender, which maybe is my favorite term, but least favorite period, where people just throw their hands up in the air and they say, you know what, I'm done. I'm just going to get out. I don't want to deal with this anymore. And of course, that often correlates to selling low, which we want to avoid as much as we can. And this really is the foundation of an entire field in financial services, in the field of behavioral finance, that is, where we could honestly spend an entire college semester dissecting this. But the bottom line is that investors are affected more emotionally, almost twice as much from losses than they are from gains on the positive side. And it's this aversion to loss that could have an effect on our ability to stay the course, stay invested when appropriate, and make those objective decisions that help us realize the outcome that we're seeking. Now, this is something that I think that, we've talked about sort of out there in the ether, maybe addressed it sort of on an academic level. But here, what we're looking at is some data that actually supports it. So I would say, you don't have to take my word for it, right? The natural tendency sort of shines through when we examine what the average investor realizes in terms of the return on their portfolio when compared to other investment positions during a similar time horizon. And so what we see here is that stocks, for the most part, beat bonds. High yield bonds did extremely well. This period was from 1999 to 2019, and then home values increased significantly. I would say that in the recent year and a half, 2 years or so, that's probably even higher when compared to this data set that was evaluated. And the average investor only returned 2.5% during this period, which barely beat out inflation. So just by less than 1/3 of 1% did the average investor beat inflation, having to do with the fact that they were often would succumb to those natural tendencies that we're referring to when compared to simply sort of putting money in the S&P and closing our eyes. You could have realized more than 2.5% of a return than trying to time the market or trying to sort of DIY it. And again, this isn't to say that there isn't a way to actively manage funds. That there certainly are, but overall the average investor tends to fall on this end of the spectrum, where returns are not as favorable as some other asset classes, or most other asset classes for that matter, and barely beat out inflation. And I think that to really key in on this point, it's important for us to understand that it doesn't take much in terms of missing the best days of return in the market to fall, to succumb to these issues. And so what I mean by that is that, if you miss just the best 10 days in the market, you tend to, or you will have lost or realized half of what you would have returned if you were invested for the entire time frame, at least as was evaluated in this scenario, where from January 1st, 1999 to the end of 2019, where this firm, Legg Mason, that's an investment manager, evaluated the performance during that time frame of the $10,000 investment. If you were invested over that 20-year period, you would have realized roughly a 5.7% return, turning your $10,000 into $32,000 basically. But if you missed just the best 10 days in the market, pulled out at the wrong time or missed the upswing on just the best 10 days, your return would have only been 2.3%, much less than half of having just stayed invested over the same time frame. And if you kind of tease that out and look at, well, if we missed the best 20 days, you see that you barely broke even and missed 30 days, just pulled your money out for 1 month, or missed the best 30 days, I guess I should say, during that 20-year period, you actually start to lose money. And so, I guess the point here is that this opportunity cost, or this, when we try to time the market and miss the mark, the consequences are not insignificant. Now, of course, those individuals who did pull out and stayed in cash positions did alleviate risk from their portfolio, but was it worth it in the long run if they intended to stay invested? And I think that the data suggests that it's not. And again, this is an area where these tendencies are something that you don't have to take my word for it. You can see it in the data with the most recent downturn. And what we're looking at is a graphical representation of what investors did during 2020. And as illustrated here, there were net outflows in stocks as of November 2020 of $325 billion. And of course, that means that people were concerned about the pandemic, they were concerned about the economic circumstances that we were in, and they pulled money out of riskier positions. And net inflows to bonds were more than $150 billion. So clear during this time frame. So clearly investors were rattled. And we have to think about this in terms of the context of staying the course, as we just discussed. Will these investors, or will have these investors who reallocated to bonds, be in the best position to benefit from the rebound? And more importantly, how have those fixed income, how have those bond positions performed over the years? And unfortunately, the data tells us that they haven't done so well. And in fact, bond yields are generally at historic lows. And with the 10-year treasury, still creeping up ever so slightly, even with inflation, it's unclear to what extent this trend may continue in the future. And I think the takeaway, of course, is that safe haven of bonds does not protect from every single risk, particularly in this environment that we're in. If we see a spike in inflation, it can have a negative effect on the performance of bonds. And that flight to safety, where traditionally investors would allocate more to fixed income, comes with its own issues, particularly today. And so what's interesting about all of this data that we're showing about market volatility and investor tendencies, mathematics of loss, everything else, is that most investors have actually told the researchers anyway, and have told us in the in institutional investing world and insurance companies, that they're actually concerned about many of these same things. But it's up to us as an industry to draw the connection between those concerns that investors have and actual market conditions. And we do so by crafting and designing the solutions that we build to align with these concerns. But I think, again, that the takeaway is that we know that this is happening based on the academic research, and investors know that this is happening as well, and they're concerned about many of the same things. As we note, older Americans say that the pandemic has made them more pessimistic about their retirement plans. Many of Americans are concerned about volatility up to 61%. So, the data is there. It's up to us to sort of come together and figure out how we address it as advisors and investors. And there are, excuse me, numerous ways to deal with risk. Traditionally, it would fall into one of these three categories. You can avoid risk altogether, reallocate to that cash or bond position. But what are you giving up on the upside in terms of staying invested? As we pointed out, how important that can be. You can simply retain the risk and deal with those fluctuations in returns, which, oh, by the way, are exacerbated significantly or become even more of an issue when we start to think about having to take distributions from those portfolios, especially from our retirement accounts, so employer provided retirement accounts and IRAs. At some point around age 72, we will be forced to take distributions from those accounts. And if we're doing so during market volatility, if asset prices are depressed because of volatility, we're forced to take those distributions. It can have a kind of a double negative effect on the ultimate return that we realize. And then the third way, of course, is to transfer that risk to another organization, which can help manage the impact of the volatility and really provide opportunities to sort of hedge against that downside risk, ultimately with the goal of realizing the intentions that we have and increasing the probability of realizing that successful outcome in retirement, whatever that may be for you as the retiree or for you as the investor. So how does this happen? How does this work? Well, again, I'm not going to get into any product necessarily, but I will speak in general terms about how some of our solutions do offer downside protection up to a certain point. And there are many different options and many different ways that these solutions can be designed to meet the specific needs of a particular investor. But just in those general terms, so we understand them, keep in mind that if you have an investment position, in this case in the form of an index variable annuity, that has a 10% downside protection. What that means is that if the market experiences a downturn in a given year by, let's say, 5%, well, your portfolio within that annuity, actually the loss gets absorbed within what they call the buffer, right? That 10% downside protection. If, on the other hand, the 10% or you experience a 10% loss, of course, that means your portfolio didn't decrease at all. Whereas, as we showed earlier, due to the mathematics of loss, you would actually have to realize a return of 11%, 11.11 to get back to even. Or in the case where you experience a 25% downturn, excuse me, a 20% downturn, in this case, the insurance company with the annuity would absorb the 10%, the first 10%, and the investor would realize the second 10%, only drawing or losing essentially 10% as a result of that 20% market downturn. Of course, meaning that to get back to even, you only need an 11.1% return, as opposed to the scenario where the same investor experienced the full 20% loss, where they'd have to see 25% gain. So, looking at this another way, and we've probably all seen data or understand how important it is to retire in favorable market conditions as it relates to the overall value of our portfolio. But obviously, it's easy to say with the benefit of hindsight, right? Nobody knows what the future holds. But within the context of this discussion, I think it is worth examining this point, because our solutions may offer a way to create that market protected position that is really in place or offered to address this specific issue. So here we'll assume we have an investor that's experienced favorable market conditions for a while and is feeling confident about having, in this case, $765,000 in that portfolio after 5 years of favorable returns, and initially, starting with $500,000. But at some point, and I guess we'll also assume that this same person intends to retire in 3 years. Well, the question becomes, what if over the course of the next 2 years, there are less favorable market conditions? How does that have an effect? What effect does that have on the portfolio? If, for instance, the value drops by 16% in year one and 12% in the next. Of course, this means that this person is now 1 year away from retirement from their original objective when they were at that market high and intending to retire in 3 years. This would leave most investors feeling, a little queasy to say the least. But it's something that, again, as investors, we have to understand that volatility and markets do fluctuate significantly. And so the questions are now, just 1 year from the intended retirement after just 2 years of negative returns, what choices does our investor have? Do they delay retirement and work longer? Do they hope for 35% returns in 1 year just to get back to even? Or lower expectations in retirement? The answer that nobody wants to give. But here's where the strategy, may or protected solution may start to come into play. And so, if you had a portion of your portfolio as an investor that was able to absorb, and as we pointed out, just even the first 10% of that loss, well, now you're in a position where instead of your portfolio decreasing to 565,000 over the course of 2 years, it's decreased to 705, because in those years you've essentially transferred that risk to an insurance company that's holding your money on and investing your money on your behalf and providing indexing credits along the way. And in this case, again, on the downside, absorbing the first 10%. So the investor only realizes 6% loss in the first year and 2% in the second, and that portfolio then being worth 705,000. So in that second year. But if in the third year you do experience a 10% gain, which everybody would agree would be favorable conditions, if you are taking on those first 2 years of loss on your own, you see that you're still not even close to getting back to even. And the math, we've done the math for us for you, so we don't have to do it on our own. And you would be in a position where that portfolio would be worth 621,000, as opposed to the protected position where it decreased to 705. And if you saw the 10% increase from there, of course, that would mean 775,000 in that portion of the portfolio. And that's, again, what some of the solutions that are available in the marketplace have to offer. And really what this is about is sort of a bucketing strategy as well. So taking a look at the time horizon that we have and what our intentions are over periods during that overall time horizon, and allocating portions of our portfolio accordingly. And so that might mean, if we're looking at 1 to 5 years of time horizon, that we would want very low risk, cash equivalent or liquidity, knowing that we're giving some up on the upside. But for those that have 6 to 10 years, or even a little bit longer than that, depending on the rest of your circumstances, taking on a little bit of that risk, but having upside potential, and then mitigating much of the downside, is something that can be attractive and can help address some of these issues that we're discussing. And then for those scenarios where we have 10 plus, 15 plus years of a time horizon, sure, greater portions to pure stocks and bonds, where we can ultimately see the return over time, even if we do deal with some downturns in the meantime, can make sense. But again, I think that understanding all these different solutions in the marketplace is really should be a part of the equation as well. And so we have to sort of ask ourselves, if these things are right for us. Ask ourselves questions like, are we nervous about market volatility? Are we too heavily invested in cash? Have we taken on, gone too far to the other end of the continuum, where we're too conservative and maybe just losing money safely as a result of inflation in a CD or a cash position, which may be fine if we want to deploy those assets, but if we want to, for something in the short term, but if we want to, enhance the portfolio, grow the portfolio over a specified period of time, we often have to take on some risk or position ourselves to realize some level of return. And so, it's with that again, I would just reiterate, some of the things that we actually started with in terms of how this environment that we're in presents unique challenges. But I would kind of turn that on its head and suggest that it actually presents unique opportunities as well, unique opportunities to, engage in the marketplace and work with financial professionals, such as those who invited you here today, to really understand how these different scenarios align with your particular set of circumstances, and consider mitigating market volatility, reviewing your portfolio holdings on an ongoing basis, and consider those solutions that provide downside protection with the upside potential. And so it's with that I'll go ahead and wrap things up, end with what I started with. And that's, again, thank you. Thanks for the chance to be here with you this evening. Greatly appreciate it. And I will shut things down on my side and turn it back to you, Lara, if you have any closing comments that you'd like to make.
Thank you so much, Steve. We really, really appreciate it. You always have great information, and that's invaluable information that most folks don't know or are scared about what's going on. I know a lot of members of the credit union don't know exactly what to do and, how to solve, the retirement. Everybody wants to retire someday. And so the goal is to make sure that you live comfortable in retirement. Now, the scary thing is what's going to happen with the markets. If you leave it in cash, if you leave it wherever, that's where we come into play. And that's why we work with companies like Prudential, and work with Steve and Joe and everybody to really make sure you guys have a comfortable retirement. And one of the things we offer is we can sit down and talk about your situation. There's no charge. We'll help you figure it out. Prudential is a company that offers a phenomenal product. Like, I've had a lot of members that have really liked the buffer products, where it protects the downside, but it also gives you the upside protection, or the upside potential. The protection is invaluable, because everybody that's been in the market, it's been really, really scary time if the market happens to drop, which it may someday. I'm hoping it doesn't, but history tells us the market will go down. So if anybody has any questions in the future, or they want to get a hold of me, I'm always available. You can always get a hold of me through the credit union. My information's in the chat. But if somebody wants to write it down, 303-870-3853. That's 303-870-3853. And I'd be more than happy to sit down with each person's situation to figure it out, to make sure that we get you go. And, not every situation is the same. So we'll make sure we tailor to your unique strategy and situation of what we need to do for you. Even if you want to leave it in cash, let's talk about it, and we can hopefully get a better way to get your money working for you and to keep it safe. So, appreciate it. And I want everybody to get back to their nights, go have dinner if you haven't had dinner, and we appreciate it. And Steve and Joe and Charisse, appreciate your time, and thank you for everything. Appreciate it, guys. And again, if you guys want to reach out, don't hesitate to let me know. So I think we're going to go ahead and end this. And Steve, again, thank you so much. So I think we're going to end this, and we'll talk to you later. Thanks, guys.
Thank you so much. Have a good evening, y'all.